Imagine Wall Street, teeming with relentless brokers and bustling with tireless traders, suddenly falling silent. Yes, the New York Stock Exchange, the symbol of American capitalism, closed its doors abruptly for the first time on September 20th, 1873. Why, you ask? An unexpected storm of financial panic gripped the nation, rooted in rapid industrialization and railroads' seductive allure. The United States was a country on the move, literally and figuratively, expanding its railroad network at an unprecedented pace. The railroads promised progress, growth, and prosperity, luring investors with the gleam of gold and optimism. And yet, inside the shimmer, lay the ticking time bomb of speculation. Investors funneled their wealth into railroad companies, often turning a blind eye to the precarious financial structures supporting these ventures. Enter the Northern Pacific Railway, a giant in the railroad industry, riding high on speculative wind. But it crashed and crumbled under its own weight of debts. It's like watching the linchpin of a great machine snap, sending shockwaves reverberating through the financial system. Therefore, the bubble burst, and fear followed like a shadow. This loss of investor confidence sparked a frantic rush. People raced to withdraw money, exposing the fragile underbelly of an unregulated banking system. Banks staggered under the weight of withdrawal demands, their knees buckling under the pressure until, one by one, they fell. Businesses knocked on the doors of borrowing, only to find them bolted shut. Thus, the rhythm of robust growth shortened into a faint trickle, slowing the economy to a painful crawl. On that fated September day, the New York Stock Exchange, the hub of this financial tornado, decided to close. The decision to suspend trading for 10 whole days was unprecedented, a signal flare of the mounting chaos and distrust in the market's stability. In the silence of its closure, the echoes of economic vulnerability grew louder. As doors slammed shut on Wall Street, fear spread through the veins of the populace. Confidence bled away as people queued at banks, desperate to salvage their savings. Banks drowned under the tidal wave of panic withdrawals, dragging businesses into the abyss of bankruptcy. The consequences were dire, weaving a tapestry of economic depression that marred several ensuing years. Yet, even in crisis, seeds of transformation took root. The panic of 1873 became America's lesson in financial prudence, ushering in an age demanding regulatory reforms and robust banking practices. It was a wake-up call to the dangers of unbridled speculation and emphasized the necessity for investor due diligence, changing the ethos of investing for decades to come. The Panic of 1873 stands as a solemn reminder that in finance, stability is golden, transparency is the compass, and regulation is the unsung guardian of a healthy economy.